been a bit since the Tax Reform and Jobs Act was passed on December 22nd, 2017, and so we thought we'd give you an update on some of the guidance that's come out from the IRS and some of the issues that that we are facing as we continue forward. The first is the mandatory deemed repatriation. This is a one-time event that took place for all controlled foreign corporations and any specified foreign corporations. There are very specific definitions. A controlled foreign corporation is a foreign corporation with more than 50% ownership by U.S. shareholders, and a specified foreign corporation is a foreign corporation with a 10% corporate shareholder. Those U.S. shareholders are subject to the mandatory repatriation. It's treated as a deemed dividend from the foreign corporation to the U.S. shareholder. And once that income is picked up for the year ended, or for the year which includes December 31st, 2017, it will be considered previously taxed income. That means that those amounts can be distributed to the U.S. shareholders without further U.S. taxation. Again, it's effective for the last tax year beginning before January 1st, 2018. That means for all calendar year taxpayers, it's the tax return for 12/31/17. But if you have fiscal year taxpayers, for example, a taxpayer whose year end is November 30th, 2017, they will not need to include the deemed repatriation until their tax return for the year ended November 30th, 2018. What needs to be done is you need to calculate the deferred foreign income of each foreign entity subject to the deemed repatriation. That deferred foreign income, or earnings and profits, very similar to earnings and profits, is calculated on two separate dates, November 2nd, 2017 and December 31st, 2017. The November 2nd date is important because that's the date that this legislation was introduced. So the IRS has set up very specific rules and what they call anti-avoidance rules for transactions that would take place between November 2nd and December 31st in order to avoid the imposition of the deemed repatriation or to reduce its amount. So that amount, the higher of November 2nd or December 31st, is picked up as a deemed dividend, similar to Subpart F earnings. The difference is the tax rate. The tax rate will be 15.5% on cash and cash equivalents, and 8% to the extent that the mandatory repatriation amount exceeds the cash amount. Again, there are two measurement dates, there are two measurement dates of cash. One is December 31st, 2017, and the second measurement date is December 31st, 2016 and December 31st, 2015 as an average. Now, if you have fiscal year taxpayers, you will be using different dates, and there's extensive guidance on how to do those calculations, especially where you have a year end of a foreign corporation that is not yet finished because their year end is not December 31st. Now, cash and cash equivalents includes cash other than blocked income, foreign currency, net accounts receivable, the fair market value of personal property that is actively traded, securities, certificates of deposit with maturities of less than 1 year, and commercial paper. Once this amount is calculated, a U.S. shareholder can make an election to pay the tax on this over 8 years, and that election needs to be filed with the tax return for the year ended December 31st, 2017, although in June, the IRS did issue some guidance that allows for late elections, and we'll get that into that in a moment. Now, if you have issues on how to calculate the amount to be included, we at WITHM have prepared templates and models that we can help you calculate that amount. But I thought I'd get into some of the guidance that has come out since the law was passed. The first came out pretty quickly on December 29th, 2017. It was Notice 2018-7, and this was really preliminary guidance. And it was guidance for determining how you calculate the aggregate foreign cash positions, how to deal with different year ends, how to deal with related party transactions, how to make sure you don't double count or double non-count the cash. It also dealt with determining your accumulated post-1986 deferred foreign income, kind of tying up those definitions. And it also gave information on the impact of related party transactions, especially transactions that took place between related parties between November 2nd and December 31st, again, so you don't have double counting or double non-counting. Then we had a little bit of a break, and the next guidance did not come out until April 2nd, 2018, in Notice 2018-13. Again, further guidance on how to compute the transition tax. The IRS introduced rules to prevent the avoidance of the deemed repatriation, and it gave further rules and elections and procedures regarding the special elections you can make. There are a series of special elections that can be made. I've already mentioned one, which is the election to pay the deemed repatriation tax over 8 years. If you are an S corporation shareholder who is reporting this mandatory repatriation, you can elect to defer tax on that until a triggering event. And there are a few other elections which might apply, especially related to REITs and other things. So Notice 2018-13 came out with those special elections that would need to be attached to the 2017 return. They also came out with guidance on how to report and make the payment of the transition tax. I'll get into these a little bit as we talk about the procedures in a few slides, but as you notice, this initial guidance was issued on April 2nd, a mere 15 days before the payments and all of the reports were due. Next page. Then on April 16th, further guidance was issued. Again, anti-avoidance rules were presented, and when they produced Notice 2018-26, they took an attitude here of assume a bad purpose first and ask questions later. So any transaction that reduced either the deferred foreign income or that earnings and profits that would be the deemed repatriation, or would reduce the cash position, those were deemed to be a bad purpose and needed to be avoided, and it was only then that you could potentially prove that you did not have a bad purpose in mind. So there are some pretty strict anti-avoidance rules. There was also guidance regarding how to treat accrued foreign income taxes, so that you didn't, you could use certain foreign taxes to reduce the deemed repatriation, but they were very careful about accruing those foreign taxes. Further guidance on the various elections that are available, and also how to treat the 965C deduction for AMT purposes. The 965 deduction is an amount that you calculate so that the income that you pick up is taxed at the effective tax rate of 15.5 or 8%. So it's not as simple as just calculating what your deferred foreign income is, what your cash is, and saying, okay, this is my 15% amount and this is my 8% amount. Instead, what you have to do is you calculate a deduction to get you to the appropriate tax rate, and then you pick up a reduced amount of income. That 15.5% and 8% rates, those are based off of the corporate tax rate of 35%. So if you're an individual taxpayer, your rates may be different because your maximum tax rate for 2017 was 39.6%. So if you were in the highest tax bracket, you might end up paying more than 15.5%. But if your income was sufficiently low, you could end up paying less than 8%. Finally, they also gave us some relief from estimated tax liabilities. So in terms of procedures, there is a Section 965 statement that needs to be attached to the tax return. If you're filing the return electronically, it needs to be separately attached as a PDF attachment to your return. The information that you would need to include has been spelled out by the IRS, and that's the total amount that you'll be including in income, what your aggregate tax position is, what the total deduction you're claiming under Section 965 is, what your deemed foreign taxes paid are, and then what the total net tax liability, including the amount to be paid in installments or the amount deferred if you're electing to defer it, and then you check the box as to which elections you are making. So that is a separate statement. Not all of the information that you need to complete this statement we calculate in our model, but it's only specific numbers that you need to report on this statement. In addition to this statement, you'll need to attach your elections, and here I've listed the elections available. The first one is that election to pay in installments. There's also an election for the S Corporation shareholders to defer the payment. A real estate investment trust can elect some deferred inclusions. Corporations can elect not to apply their NOL deductions to reduce the deemed repatriation amounts. And finally, a late notice also allowed you to use an alternative method to compute the post-1986 earnings and profits, and that notice required an election to be attached to the return as well. So a lot of attachments to go with your 2017 tax return, and then you need to pay the tax. So there are two separate payments that are required. First is your regular tax that was owed for 2017, and then specifically a separate payment for the 965 tax that was not otherwise satisfied by another payment or credit. The IRS specifically requested a separate, for individuals, a separate voucher with the 965 payment. If you were a corporation that is required to use the electronic federal tax payment system, you must use a wire transfer to submit the 965 payment, and that's because the EFTPS system was not set up yet to receive 965 payments. If you do not transfer this via wire transfer, penalties will apply for not making electronic funds transfer. This last bit came out literally the day before tax returns were due, and that deals with the application of 2017 estimated tax payments. So if you've paid in plenty of tax and then you have a 965 tax, the IRS has said they will first apply your 2017 estimates to your regular 2017 tax liability. Thereafter, they'll apply it to the Section 965 tax, but they will include amounts that are subject to future installments, even if you've elected to pay it over 8 years. Thus, no refunds of excess 2017 taxes paid will be issued if the overpayment doesn't cover the full 965 tax. So this was a bit of an eye-opener to tax preparers and taxpayers around the world that, or around the U.S., that you're not going to be able to get any excess 2017 estimates back. Instead, they will be applied not just to the first required installment of the 965 tax, but all installments of the 965 tax. So having gotten through filing season, on June 4th, the IRS came out with some late election and late payment relief. And this applies to individuals if the transition tax is less than $1 million. There's going to be no addition to tax and no penalties for failure to file if the first installment wasn't paid by the due date of the first installment, but as long as it's paid by the due date of the second installment. Also, although the law said that if you don't make the first payment, the subsequent installments will be accelerated, as long as you pay the first and second installment by the second installment date, you won't be subject to the acceleration. So the new due date, as it were, is April 15th, 2019 for domestic taxpayers and June 17th, 2019 for any U.S. taxpayers living outside of the U.S. Finally, if you've already filed a tax return, you can still elect to pay the transition tax in installments as long as you file an amended 2017 tax return with the 965 statement and the 965H election by October 15th, 2018. The IRS has put all of this together in a new publication, Publication 5292. It covers who's required to report, how you calculate the reporting amounts, what the attached statements are. It has numerous workbooks on how you calculate these amounts. It defines the elections that can be made and has a section on who can make an election, when the election must be made, and how the elections are made. This was published pretty much in between the April 15th deadline and the recent June 4th guidance. So I have a feeling it will need to be updated for the June 4th issuance of late election relief, but that's a very good resource for everything deemed repatriation in one 15 or 16-page document.
Okay, and then that brings us to our first polling question for today. The Section 965 deemed repatriation, A, is effective on December 31st, 2017. B, must be measured on 2 dates, November 2nd and December 31st of 2017. Is taxed at 15.5% of cash and 8% in excess of cash. D, must be reported via a separate statement, or E, all of the above. And we'll give you 30 more seconds to respond. Okay, just a few more seconds. All right, we're going to close the poll and share the results with everyone. So 87% selected E, all of the above.
And that is the correct answer, Tanina.
Great.
With that, I'd like to turn the presentation over to Haya Siegfried, who will discuss the Global Intangible Low Tax Income provisions.
Thank you, Kimberly, and welcome everyone. So with respect to global intangible low taxed income, this is probably one of the most impactful provisions of the tax reform. Unfortunately, if you were dialing in or tuning in today to hear about any IRS updates, there really hasn't been anything. As a matter of fact, in preparing for this class, I went to the IRS website and Googled both GILTI and global intangible low taxed income, and the IRS could not find anything on either of those items. So what's a little scary about that is this global intangible low taxed income regime is applicable to the 2018 calendar year taxpayer. So any tax year beginning after December 31st, 2017 is subject to this provision. And we're more than halfway through the year, and we really haven't gotten a lot of clarity from the IRS on this. And you know, there are some things that we do understand and some things we're still trying to figure out how they're going to work. So today, we won't be talking about IRS updates, but we will, again, review from a high level what exactly is GILTI, what does it mean to U.S. taxpayers, and we'll talk a little bit about what we're finding in practice when we actually put paper to pencil and run some numbers, and also some planning ideas and walk through those a little bit. So jumping right in, the policy behind this global intangible low taxed income, there was this sentiment in Congress as they were drafting the new tax law that some of the provisions in the law further incentivize taxpayers to shift profits abroad. So there's always been this incentive because the corporate tax rate in the U.S. is 35%, and elsewhere it was lower, and obviously we know it has changed now to 21%, but there's always been this incentive to shift income abroad to countries where they're either lower taxed or no tax. And we know that we've moved from a worldwide system of taxation to a somewhat territorial system of taxation, and there was a concern that that change in how the U.S. taxes the earnings of foreign subsidiaries would further encourage U.S. taxpayers to shift their profits overseas. So the GILTI provision was put into place to reverse that and to take away the benefit from taxpayers attempting to shift their profit overseas, and specifically the income that's easiest to move overseas is this intangible type income, because there is no tangible assets. It's so easy to just say that those assets were moved overseas, thereby the income generated by those assets are moved overseas. And typically, from an economic perspective, those are the assets that are generating the higher rates of return. So what GILTI is, it's a new category of income. It's conceptually similar to Subpart F in that if a taxpayer has GILTI, it's deemed repatriated in the year that it's earned. It is the income of a controlled foreign corporation that are reduced. So our starting point is the earnings and profit, or the net income of your controlled foreign corporation, reduced by any U.S. effectively connected income, reduced by any other types of Subpart F income under Section 951, which are our historical types of Subpart F income. And then you compare that number, so that would be called our CFC tested income. You compare that number to the CFC's qualified business asset investment, and the qualified business asset investment is the CFC's assets that are used in a trade or business, the net tax basis. So you come up with that QBAI number, their qualified assets, multiply that by 10%, and then to the extent that the tested income exceeds the 10% of the QBAI, the CFC would be deemed to have GILTI. So the key thing to remember, and we'll walk through this because it's a little bit of a hard concept, so I put some numbers here to kind of help us understand these concepts. But the key thing to keep in mind is that this only applies to controlled foreign corporations. And so if you don't have a CFC, you don't have to worry about GILTI. So Tanina, next slide, please. So to give us a sense, we hear this term intangible assets being thrown around a lot. What are our intangible assets? So on the left side, we see our 167 depreciable assets used in a trade or business. These are easy to identify. These are on our balance sheet typically. These are what our QBAI would be, our qualified business asset investment. Our intangible assets, on the other hand, are on the right-hand side. These could be marketing intangibles, computer software, a formula that a company uses, any type of proprietary information, customer-based intangible. These are what we're referring to when we talk about intangible assets. Now, the way that the GILTI provision was drafted, because it's hard to identify exactly what our intangible assets are, very often a business won't have their intangible assets on the balance sheet, because if it's self-created, then it's not going to be reflected on the balance sheet. So the way that Congress drafted this provision was, we look to our qualified business asset investments, which are our assets that are used in trade or business. We look at the net tax basis of those assets. 10% of we were given this rate of return that Congress says, those assets should be earning a rate of return of 10%. Any income that exceeds 10% of your fixed assets is going to be income that is associated with intangible assets. So walking through an example real quick, if we have a CFC that's got $1 million of income taxed at a 23%, this is an Israeli CFC, corporate rate of 23%, fixed assets of $2 million, Subpart F income, we'll call it foreign personal holding company income, so historical type 951 Subpart F income. We have $1 million less the tax, because that's an EMP adjustment, or a total EMP is $770,000. We have, Tanina, I'm sorry, next slide, please. We have Subpart F income of $200,000, and so we're down to $570,000. So that $570,000 is going to be our CFC tested income, and then we mentioned that our assets used in a trade or business are the $2 million. We're allowed a return of 10%. So the difference between the $570,000 and the $200,000 is our GILTI. So now we know pretty much from a high level how to compute our GILTI income. The question that, the next question should be, well, how are we taxed on this income? And Tanina, if you can just jump to the next slide, please. So this is a bit more complicated because GILTI is taxed differently to different taxpayers. So if you're an individual shareholder in an investor or an investor in a flow-through entity that has an investment in a CFC and is generating GILTI, this income, again, it's a deemed inclusion at the ordinary rates. So you would be paying the highest ordinary tax rates on this income without any foreign tax credit offset. Now, Section 250 for C Corps provides a 50% deduction of the C Corp's GILTI. So it's like a 50% dividend received deduction, and that gets us an effective tax rate of 10.5%, which is half of your 21% corporate tax rate. So the starting point for C Corps is about 10.5%. And then we know that C Corps are allowed an indirect foreign tax credit if they own 10% or more of the CFC. And so they would be allowed that indirect foreign tax credit on this GILTI income, but only with an 80% deemed paid credit. So whatever the foreign tax credit should be, they have to shave off 20% of that, and just they're left with the 80%. And keep in mind that GILTI has its own foreign tax credit limitation basket, so it can't be offset with other types of, with foreign taxes coming from other types of income. Tanina, next slide, please. So this is what it would look like if we had an individual shareholder in that Israeli CFC. The effective tax paid on this income would be 60% because, again, they're paying the local country tax and then residual tax. There's the U.S. tax of 39% without a foreign tax credit. Our C Corp, on the other hand, doesn't have such a bad answer because, number one, the tax rate for the C Corp would be 10.5%, and they would be allowed a foreign tax credit, so there'd be no residual income tax paid. So although there'd be a GILTI inclusion, there wouldn't necessarily be an additional U.S. tax due on that income. Now, I'm going to pause here for a second and just say that, you know, the thing that we have learned in the last couple of months and running through some of our running through the numbers of some of our clients is that while you may think if you're a C Corp with GILTI from a CFC that's a resident in a country whose tax rate is more than 13%, because the 80% of 13% gets you to 10.5, so that's kind of the line that we're looking at. When you do the computation, you may find, actually, you may be surprised and find that there is a U.S. tax due because for whatever reason, the foreign tax credit may not be as high as what the statutory tax rate in that country is. So say, for instance, UK, 19%. If you have a CFC in the UK, you would think, okay, my local country statutory rate is higher than 13%. So even if I have GILTI, I'm a C Corp, I don't have to worry because I have a foreign tax credit. But if for some reason in the UK you have an NOL that you're using to offset your UK tax liability, you would not have a foreign tax credit available in the US, and then you would have a GILTI inclusion. So it's important just when thinking about this, when communicating with our clients, just to keep in mind that, you know, from a high level, it may not look like an issue. When you actually run the numbers, it may become a problem. Tanina, next slide, please. So C Corps are currently the best structure to be in for GILTI inclusions because of that Section 250A deduction. And for individuals, however, if we're looking at individuals that own CFCs either directly or through flow-through structures, they need to really be thinking about restructuring because a GILTI inclusion to an individual is going to have a harsh result, as we had seen on that earlier slide. So next couple of slides, we'll talk about some ideas around tax planning around this. Obviously, the easiest one, the first one, is checking the box, make an election to treat the CFC as a transparent entity for tax purposes. And what that does is you have the same full inclusion, but now you are allowed a foreign tax credit. So say, for instance, with our Israeli tax example, the C Corp shareholder would have to include 100% of the income, but there would be a foreign tax credit. So the top the ETR, the effective tax rate, would be the 37% as opposed to 60%, because the Israeli tax credit would offset the US tax, and that's only allowed if it's a flow-through entity. One cautionary note on this is electing to treat a CFC as a disregarded entity is considered a deemed liquidation. And so if this is an investment that's been around for a while, or it's a structure that's been in place for a while, you do need to consider the impact and whether or not checking the box will result in a gain due to the deemed liquidation. Tanina, next slide, please. Thanks. So another idea, which is a bit more cumbersome, but maybe attractive to, you know, if the investment is large enough, is to insert a U.S. C Corp holding company between the U.S. individual and the CFC. And what this does is, say for example, in this instance, our CFC is a UK tax resident. The income earned by that CFC is subject to UK tax. The U.S. holdco would have a GILTI inclusion. However, as we had mentioned earlier, there would be that dividend received deduction and a foreign tax credit, which would result in no corporate level tax in the U.S. And then subsequently, when the income was distributed to John, you know, to our shareholder, John Smith, our individual shareholder, the income would be considered a qualified dividend. So there'd be a 23.8% tax on that. So our effective tax rate would be 38% with a distribution. And in the absence of a distribution, if there wouldn't, so if we left the cash in ABC UK Limited, our effective tax rate would basically be the UK tax, because there would not be a US hold company level tax. Tanina, next slide, please. So this last idea that we'll talk about it's an interesting one. It's a solution that will work for some, but not for all, and I'll explain that to you. But what's interesting about this is that this Section 962 has been on the books for for decades. I think it's probably half a century at this point. And initially, it was put into place to address the fact that individuals do not get an indirect foreign tax credit. So what the Section 962 election does is it allows individuals to be taxed as a corporation, which means that the individuals would be subject to a corporate rate, but they would also be allowed a foreign tax credit. And so historically, when the corporate tax rate was up around the individual tax rate, that didn't always make sense, and we'll discuss. Well, we can discuss that right now. And the reason is that when you make a 962 election on an inclusion, at the time of the inclusion, you are taxed as a corporation and you are allowed the foreign tax credit. But at the time that the actual cash is distributed with a 962 election, that cash distribution would be considered income again, less any taxes that you had paid. But for the most part, most of the distribution would be considered taxable. So individuals would be paying tax twice on the same income effectively. When your corporate rate is at 35% or higher, and your individual rate is around there, so you'd be paying both of those taxes, that 962 election didn't really make sense and wasn't used very often. Now, in light of the fact that the U.S. corporate rate has gone down to 21%, and you know, the GILTI inclusion for individuals is so harsh, this 962 election becomes attractive again. What's unclear, and this is something that we'll have to wait for guidance from the IRS on, is the Section 250 deduction that we had discussed earlier, which basically allows our C Corps a 50% dividend received deduction on GILTI income. It is not clear if that deduction will be available for taxpayers with the 962 election. Just the way the law was written, it doesn't seem 962 does not address dividend received deduction, so it's not specifically allowed. Therefore, it would seem that it may not be allowed. But if you look back at the historical intent of the 962 election, it does appear that it should be allowed. So this is one of the items that a lot of us are waiting, with bated breath to hear from the IRS, to hear from Chief Counsel's office to see if this would be allowed for taxpayers. Sanina, next slide, please. So using nice round numbers to see what the 962 election would look like. And in this instance, I've also modeled the actual distribution of cash, because with a 962 election, that becomes so relevant because the income is taxed again. So on the left, you have John, who does not make a 962 election, and this is in an Israeli CFC. And without the 962 election, John's got guilty inclusion that he pays a tax of 37% on and no foreign tax credit. And then if you look down where it says in subsequent year of distribution, while there's a dividend and local country withholding on it, there is no U.S. inclusion. But if we add the corporate income taxes, the tax that John paid on guilty, as well as the local country withholding tax, we come out with an effective tax rate of 70%, which means that taxpayer earned $100 and gets to keep 30. That's not a good answer. For John with the CFC, with the 962 election, again, this is an Israeli CFC, this assumes that the Section 250 dividend received deduction is not allowed. Even so, because the corporate tax rate is only 21% and we are allowed a foreign tax credit, John will pay, the CFC will pay the local country income taxes, and then John will have a residual tax in the US of $2,600. Subsequently, and this is where the 962 impact comes into play, subsequently, when there is a cash distribution, John will have a US inclusion of the dividend amount less the residual, the tax paid, so less the $2,600. So there's an inclusion of $74,400, and that would be taxed as a qualified dividend. Plus, on that inclusion, on that item of income, the withholding tax would be allowed, because the withholding tax is considered a direct tax. Therefore, if we look overall from when the guilty was incurred and when the distribution was made, John would have an effective tax rate of 44% or 45%, which is a much better answer. So this works for, some of the rates I've used may not be perfect, but they're pretty close to what the actual rates are in Israel. So this works for a U.S. taxpayer with an Israeli CFC because of the rate of tax on corporate income in Israel, as well as the withholding tax on distributions. Tanina, can we go to the next slide? Now, if we switch up one fact, which is instead of an Israeli CFC, we have a CFC in Hong Kong, the answer changes a bit, because without a 962 election, the local country tax in Hong Kong is only 16.5%, and then John pays another 37% on top of that. There is no withholding on distributions out of Hong Kong, and so when John receives the actual distribution of income, it's considered previously taxed income. It's not taxed again in the US, and his effective rate is going to be 48%. Now, and I see there is a typo there, but if John makes a 962 election on this same Hong Kong CFC, he would have a residual US tax on the guilty of $7,800, because the Hong Kong tax is low, and the Hong Kong effective tax rate is low, and we are not taking that Section 250 deduction. And then upon receipt of a distribution, John will have an inclusion again, but there is no withholding tax to offset that inclusion. And so this, a 962 election with a Hong Kong subsidiary may result in a higher effective tax rate of about 52, 53%. So what's key here is it's important, it's a good tool to have in the toolbox, it's something to think about, but you do need to run the numbers country by country, taxpayer by taxpayer, to see whether or not a 962 election makes sense. And again, a lot of that question, will have an easier time addressing that question or answering that question when and if Treasury decides to give us guidance on that Section 250 dividend received deduction. And Tanina, I think that brings us to the next polling question. Oh, okay. So again, yep, one last slide I see. So again, we just need to be assessing, our clients, if we're responsible for taxpayers or ourselves, and just assessing, what is our current structure? How is it going to be impacted by tax law? Do we have, by tax reform, do we have CFCs? And then consider what makes the most sense to avoid a guilty inclusion, either for a C Corp, but definitely for an individual. And that brings us to the polling question.
Okay, great. I'm going to launch the second poll. Which of the following is not deducted from net income in determining GILTI? A, subpart F income. B, foreign taxes paid by the subsidiary. C, interest expense. D, net operating losses of the parent. E, 10% of qualified business asset investment. It'll take about 30 seconds to collect responses. Coming in. Okay, just a few more seconds. All right, I'm going to close the poll and share the results. We had 48% select D, net operating losses of the parent.
And that
Thank you, Tanina.
is
Yes.
the correct answer. Yes, thank you, Tanina.
Great.
Kimberly, I'll turn it back
Okay.
over to you now.
Thank you so much. We had one quick question from the deemed repatriation section, which dealt with estimated tax payments and the overpayments applied. For 2017, the IRS has indicated that any 2017 overpayment would be applied to the 965 tax in total, so they would not be making any refunds of excess 2017 estimates if the 965 tax wasn't paid in full. If they're going to continue to do that in 18 and 19, they have not announced yet, but I would say any client who has elected the installment, you want to be very careful that you're not tremendously overpaying your 18 estimates and you're making specific payments for the 965 tax so that you don't end up with the IRS getting your taxes well in advance. So unfortunately, they have not indicated anything for 2018 installments, but for 2017, I think they would probably take the same approach. So we need to be very careful with those taxpayers. We're going to spend the last few minutes of our session talking about both the base erosion anti-abuse tax and some miscellaneous tax provisions. So base erosion profit shifting was an initiative of the Organization for Economic Cooperation and Development, which has had worldwide implications, but through that, our Congress implemented a brand new type of corporate minimum tax called the BEAT, the Base Erosion Anti-Abuse Tax. And what this is, it's a 10% tax on the modified taxable income of the corporate taxpayer. And to the extent that that amount exceeds regular tax, you will pay that as basically an alternative minimum tax. Modified taxable income is very different from the prior corporate AMT. It's taxable income plus payments to related parties that result in a tax deduction for tax purposes or depreciation expense on assets acquired from related parties. And these are payments where there is no U.S. tax paid on those payments. So for example, if you have interest paid to a related party, but the U.S. withholds tax on that interest, that is not considered a base erosion payment. The base erosion tax applies only to C corporations whose average annual gross receipts are greater than $500 million, and their base erosion percentage, which is the percentage of base erosion payments made to related parties divided by total deductions, is greater than 3%. Now, when they discuss related parties, there is a new definition of related parties for this purpose, and it's a 25% owner of the taxpayer or any person, which can also be an entity, related to the 25% shareholder. Now, where is all of this reported? This is usually always reported on Form 5472. So there are 2 points to note. One is that we anticipate there's going to be drastically more reporting requirements of related party transactions on this form so that the IRS can make sure that the BEAT is properly calculated. And also, the IRS is increasing the penalties for failure to report on Form 5472. So that's a missed form or an incomplete form. That's going up from $10,000 per year per form to $25,000 per year per form. So someday, as the father says to his son overlooking their business, someday all of this will be seized by the government for failure to file. We could input here Form 5472 instead of just Form 5471. So let's go very quickly through an example. If you have a company whose gross receipts are $750,000 and their total expenses are $600,000, they have taxable income of $150,000. Because their gross receipts, and we'll assume this is pretty static over the years, their gross receipts are in excess of $500,000, they are subject to the BEAT. So next we look at what kind of payments they make. So in our example, they paid a royalty to a foreign parent of $100,000. There was services to other foreign affiliates of $75,000. They did pay interest of $15,000 on which U.S. withholding was applied. And finally, they acquired some assets from related parties and the depreciation expense thereon was $8 million. So in this, the only payment that is not considered a base erosion payment is that interest. So the total base erosion payments are $183 million. And this represents 31% of the total deductions of $600,000. So then we look and say our modified taxable income is the $150 million of taxable income plus the $183 million of base erosion payments for a total of $333 million. So the 10% tax thereon is $33,300,000, which exceeds the regular tax at 21% by $1.8 million. So the BEAT here is $1.8 million. So as we look at all of these provisions, our historical Subpart F income and our GILTI computation, first we look at those two ways of calculating corporate income tax, and it's only thereafter that we calculate the base erosion anti-abuse minimum tax. So this is an additional calculation that will need to be done, but it does come after those two parts. And that brings us to our third polling question.
Great, and apologies, I didn't hide the results, so they missed the first two slides as you were chatting.
Oh, sorry.
And I'm going to launch the third poll now. What is the new penalty rate for failure to file Form 5472? A, $10,000 per year per form. B, $25,000 per year per form. C, $100,000 maximum per entity, or D, $100,000 maximum per year. Just about 30 seconds. Okay, 5 more seconds. Close and share the results. We had 66% select B, $25,000 per year per form.
That is the correct answer. Thank you, Janina.
Hide the result.
Okay, now in the negative minutes that we have left, I want to just review quickly some of the miscellaneous provisions of the Tax Act of 2017. There are a number of miscellaneous acts. I want to point out specifically on this slide the fourth one down, which is that there is a change in how income is sourced when we have the sales of inventory. Previously, sales of inventory were sourced 50% to the state of production and 50% to the place of sale. The revision of 863B says income from the sale of inventory will be sourced to the location where the inventory is manufactured or produced. Also, one of the biggest changes is a change in the attribution rules for determining CFC status. And you will now include attribution of stock owned by a foreign person if that foreign person is owned by a U.S. person. So there are some examples here. The important thing to note here is that this is retroactive for purposes of the deemed repatriation, but also that this means that because of GILTI, because of the foreign derived intangible income, because of all of the international changes, you will want to review every single international structure to make sure that you've effectively managed the taxes. Another key provision is that a foreign corporation no longer needs to be controlled for 30 days to be considered a controlled foreign corporation, as long as it's owned on any day, or as long as it's controlled on any day, it will be a CFC. And finally, one of the big changes here is that there was a related party look-through rule that was first passed in 2009 as a temporary measure. Everyone expected that to be made permanent. It was not made permanent. What this allowed U.S.-based multinational groups to do is deploy earnings from one subsidiary or a subsidiary in one country to another country without creating passive income that might be Subpart F income, and so that has changed. Again, this will require looking at structures to make sure you're effectively structured. So as we look through all of the changes, the international changes under the Tax Cut and Jobs Act of 17, the issue here is that the big winners are the C corporations and the shareholders of the C corporation shareholders of controlled foreign corporations and other entities. They are, while they may be subject to GILTI, they are benefiting from the reduced tax rate. They are benefiting from the foreign derived income, and they will still get their foreign tax credits, and they can manage it. The losers here are individuals and investors in flow-through entities because of the GILTI, because of the way things are structured. And I think you can see from some of Haya's examples, the tax rates can go as high as 70% if they're not structured properly. So we really need to think about our structuring and how best U.S. taxpayers can own entities abroad and report their income abroad. And with that, we'll go to the final polling question.
Okay. Watch the final poll for today. Which acronym was not introduced as part of the Tax Cut and Jobs Act of 2017? A, AMT, B, GILTI, C, BEAT, D, QBAI, or E, FDII? If you have any other questions, you can enter them in the chat box now, and the presenters will answer them. A few more seconds. Okay, we're going to close the poll and share the results, and we had 72% select A, AMT.
Correct. The AMT was introduced well before 2017. The FDII, the foreign derived intangible income, we did not cover today. That is basically the flip side of GILTI for U.S. taxpayers who have foreign source income from intangibles. If you have any questions, our contact details are right there. Please feel free to reach out to me or Haya with any international questions. Thank you for your participation.
Great, and yes, thank you for attending, and please remember to take a moment to complete the online survey. It will pop up as soon as you close out of the webinar. So great, thanks, Haya.